you Commerce Secretary, maybe Howard. Hi, Howard. He's doing some interesting work right now with all that's going on. He's right in the middle of it and doing a great job. Thank you. SBA Administrator Kelly Loeffler. And thank you. SEC Commissioner Hester Pierce. Thank you, Hester. Acting CFTC Chairman Caroline Pham. House Majority Whip Tom Emmer. Hello, Tom. Representative Brian Stile. Thank you. Brian, thank you very much. Digital Assets Council Director Bo Hines. Good, Bo. Great job. And many other distinguished guests. We have a lot of very distinguished people around the table. Some of them will be speaking. I want to thank Marco Rubio also, who's right over there. And we have tremendous people very interested in this subject. And last year, I promised to make America the Bitcoin superpower of the world and the crypto capital of the planet. And we're taking historic action to deliver on that promise, as you know, around the table. Yesterday, I signed an executive order officially creating our strategic Bitcoin reserve. And this will be a virtual Fort Knox for digital gold to be housed within the United States Treasury. That's a big thing, Scott. The federal government is already among the largest holders of Bitcoin, as you know. Really one of the largest holders in the world, with as many as 200,000 Bitcoin obtained via civil law and various other forms of law, and including enforcement actions. These existing holdings will form the foundation of the new reserve. Unfortunately, in recent years, the U.S. government has foolishly sold tens of thousands of additional Bitcoin that were worth billions and billions of dollars had they not sold them, but they did sell them, mostly during the Biden administration. Not a good thing to have done. From this day on, America will follow the rule that every Bitcoin knows very well: never sell your Bitcoin. That's a little phrase that they have. I don't know if that's right or not. Who the hell knows, right? Who knows? Who knows? But so far, it's been right. And well, let's keep it that way. The Treasury and Commerce Departments will also explore new pathways to accumulate additional Bitcoin holdings for the reserve, provided it's done at no cost to the taxpayers. We don't want any cost to the taxpayers. In addition, my order directs federal agencies to conduct an inventory of all crypto assets currently held by the U.S. government and determine how they can be transferred easily to the Treasury. Non-Bitcoin digital assets will be held in a new U.S. digital asset stockpile where they will be managed properly. My administration also is working to end the federal bureaucracy's war on crypto, which was really going on pretty wildly during Biden until the election came about. About 5 months before the election, he became a big fan because he heard how many people were in favor of it and how many people love it and respect it. But I guess it didn't work out too well for him. People understood what was going on and paved the way for groundbreaking innovations in institutional finance. Under the Bitcoin administration, regulators strong-armed banks. I mean, they really did. They strong-armed banks into closing the accounts of crypto businesses and entrepreneurs, effectively blocking some money transfers to and from exchanges, and they weaponized government against the entire industry. But I know that feeling also. Maybe better than you do. All of that will soon be over, and we are ending Operation Choke Point 2.0.
That's the president, of course, at the White House, Digital Assets Summit underway, where the president did call the United States the Bitcoin capital of the world, the crypto capital of the planet. And we're going to continue to monitor that for you, bring you any other headlines. But probably saw the president flanked by some cabinet members, also MicroStrategy's Michael Saylor, and the Coinbase CEO Brian Armstrong there as well. Again, we'll keep our eyes peeled there, bring you anything you need to know. In the meantime, let's do the Closing Bell Market Zone now. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of the trading day, plus two corners of the market hit hard this week. Leslie Picker on financials, Seema Modi on software names. Michael, I'll begin with you. Maybe it was the Fed chair who just sort of calmed the water a bit.
It coincided with him beginning to speak and him essentially saying, conveying some flexibility, obviously, to not just sort of take any price increases from tariffs as some kind of a reason to get more hawkish. I do think, though, the market has been attempting to get to that point of enough for now. Not that we've resolved the big issues, but that 7-8% down in 12 trading days, which is what it's been for the S&P 500, really has just sort of swiped away a lot of the froth and reset expectations to a fair degree. I don't think that we got some kind of really fat pitch on a technical level that says this is a big and enduring low, but a better sign to lift off the lows into the weekend, even if it means it's not all over.
I mean, you didn't want to go and close below the 200-day on the S&P.
No,
if you could avoid it, you'd rather not do that.
And also, we sort of reverse back to the highs of July. I mean, really going back a good distance in time to say that we've had this bit of a reset.
Yeah. If there's been a trade, Leslie, that's been pretty upset, it's been the financials. Tell us more.
Oh, yeah. It's been a really ugly week for the banking sector. Fundamentally, though, the banks are intact. In fact, over the last few weeks, we've gotten a slew of mid-quarter updates from bank executives at a variety of conferences, and Piper Sandler sums up the commentary as being modest Q1 guidance changes, no revisions to full-year expectations, encouraging deposit commentary, customer stability, and hopefulness on the new regulatory regime. The Piper analysts say, quote, taken together, despite all the renewed uncertainty, stories are on solid ground at present, and there remains the promise of many emerging tailwinds in the coming periods in our view. As for this week's action, they chalk it up to an unwind of the Trump trade from which the sector had previously benefited. However, if some of the investor concerns about the economy really come to fruition, that would, of course, have a very adverse impact on the banks. Scott.
All right, Leslie, thank you for that. That's Leslie Picker. Let's talk software now with Seema Modi. Tell us what you're seeing.
We're watching AppLovin, Scott, because tonight we're expecting an update on which stocks will be added to the S&P 500. AppLovin has been rumored to be on the list. Citi's trading desk adding that if the software name is not included, shares could continue to fall. It's higher today by 4%, still down 17% for the week. But today, the worst performing software name is Samsara, delivering a more conservative fiscal outlook due in part to tariffs. CEO talking about how customers are prioritizing finding ways to bring costs down this year. It follows weak guidance from CrowdStrike and MongoDB, two of the biggest losers this week. And next week, the conversation turns to Oracle, earnings on Monday, plus that tech CEO meeting at the White House, which will also begin on Monday, Scott.
All right, Seema, appreciate that. Thank you. That's Seema Modi. We've got about 90 seconds, Mike. Notable names to discuss for a minute. Tesla, down 10% week to date. What's your thought here?
I think you have to be looking at this point for forced liquidation, capitulation type metrics just because of the depth of the decline. It's funny that stocks are still moving on the idea that they're going to go into the S&P 500. Tesla's barely above where it is 4.5 years ago. It went into the S&P 500 at that price above 200. So I don't think there's any magic there. I think it's probably helpful big picture to have a lot of the meme-ified mega caps start to roll, or they have rolled, and just sort of get that out of the market system. The momentum reversal has been profound. It probably hasn't fully gone back to flat from where we started, let's say, a few months ago, but it's all kind of helpful. It's building into this argument that you can make that, we've sort of taken enough pain in the short term. The issue with perhaps the banks going down, though, is you want them to get a bid because you don't want it to say that there's something systemic happening, that the cross-asset volatility with yields and FX is starting to present the possibility of some kind of infection to the capital markets. I don't see it right now, but you want that not to start.
You've been watching credit closely, and you've had a little bit
it's wobble.
Widening. It's a little bit.
Yeah.
But the bell's going to take us into the weekend, at least on a green note. That does it for us. Everybody have a good one. I'll see you on the other side of that into OT with Morgan and John.
That bell marks the end of regulation for the week. Women in financial markets ringing the closing bell at the New York Stock Exchange. Dolphin doing the honors at the NASDAQ. Stocks turning higher midday after some soothing words from Fed Chair Powell, but still closing out a bumpy week for the bulls. Soft data and tariff uncertainty weigh heavily on the major averages. That's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort with Morgan Brennan.
Well, ahead this hour, tech's terrible week. We're going to talk about the big drawdown for names like Tesla, Nvidia, and Netflix, and if it's time to start buying these dips.
Plus, the next wild card for investors. Raymond James Washington policy analyst Ed Mills will join us to discuss next week's government shutdown deadline.
And we will bring you the latest on the White House Digital Asset Summit that is taking place as we speak, as you can see right there on your screen. That's following the administration's move to create a strategic Bitcoin reserve.
Now let's get straight to the market action as we wrap up a week, perhaps to forget for the bulls. Joining us is Unlimited CEO and CIO Bob Elliott and Kestra Investment Management CIO Kara Murphy. Guys, happy Friday. Bob, stocks or gold?
Well, I think stocks are facing a pretty tough circumstance right now. The incredibly elevated expectations that we had coming into the year have come down a little bit with this price action. But so far, the type of fiscal tightening activities that are being expected to be rolled out over the course of the next couple months have yet to really at all be fully reflected in how weak we're likely to see nominal GDP play out. Look, there's some concern about a bit of the tariff volatility, a bit weaker employment conditions than was originally expected, but that's nothing compared to the type of tax policy pay-fors that are likely to be in place, the constriction from immigration, and the significant efforts to curtail federal spending.
Kara, diversification is something we're hearing more about these days after quite a run for mega caps and tech. What does diversification really mean in this environment for so many people who are now overweighted toward those things that have gone up so much? Where does international fit in for you, and what about fixed income?
I think it's such a great question because for 2 full years, diversification got a bad name, right? Like most of the returns were coming from a handful of stocks that just seem to go up every day. Now, so far this year, we've seen bonds chugging along. We see EFA having a really strong year, vastly outpacing U.S. stocks. So I think it's just a good reminder that, the market doesn't always stay with just a handful of names, and it makes sense to have exposure kind of around the world. So as we look at, sort of like the winners so far this year, I really think it's the diversified portfolio that's coming out as the hero.
Bob, I want to get your thoughts about the push-pull, I'd argue, we're seeing in the market between monetary policy and the officials associated with that. Look no further than Fed Chair Powell this afternoon, whose words were taken as soothing by investors in this market, and fiscal policy. And yes, a lot of uncertainty, but keep in mind only 4.5 days into this, what I would call maybe a trade war, negotiation, whatever we want to call it, as well, but obviously causing a lot of volatility. If there's a lot of noise, to use the term that Powell used, how do you cut through that to what's actually taking place and thus what it means for investors?
Well, I think the challenge in this sort of circumstance is there's an incredible amount of volatility. And so it's not a time to have high conviction in one direction or another, because one day we have 25% tariffs on our 3 major trading partners, and the next day they're all gone. And so that sort of volatility, very, very hard to manage. What we're seeing is that that's forcing professional money managers to take risk off the table. And part of what we're seeing in terms of the cross-market dynamic is that, the long positions that a lot of those leverage investors had are being drawn down. That's some of the market action that we're seeing in the tech names, and some of the short interest positions are getting cut back. And we're seeing outperformance there as well. And so that sort of environment is challenging, because the question is who is going to be the incremental buyer for risk assets in an environment where there's so much policy uncertainty. And when you get those leverage players pulling back, like we've seen across the hedge fund industry, there's not a lot of incremental bid there that isn't already all in on equities so far.
Kara, I mean, it's worth noting that we came into the year and really started the year arguably overvalued for the S&P 500 and quite a few of the stocks that have been outperforming over the last couple of years. A lot of conversations about the broadening out, about the rotation. we're seeing in this market between sectors, but also a lot of talk, particularly this week, about the fact that we are seeing a pullback, maybe even, depending on what you're watching, a correction. At what point do you look at this market and you say, okay, we're right-sized, expectations have gotten in line with this moment we're in, and you buy into some of these more perhaps economically sensitive parts of the market?
So, you mentioned valuation at the start of your question, and we could have said all of those things a year ago, right? Valuations were looking fairly high in U.S. stocks, particularly among the Mag 7, and then we had another 12 months of those names continuing to do well. So I think having high valuations alone is not a great timing indicator for the market. What it tells us is that expectations are fairly high and that companies better continue to meet those expectations. So we've talked a lot about earnings momentum and how that's really an important driver of the market going forward. And that's where we start to get a little cautious towards the second half of the year, because what we see is Mag 7 earnings continue to outpace the market, but the degree to which they outpace the rest of the U.S. stock market declines. And then we're also starting to see some non-U.S. companies starting to see more earnings momentum relative to those Mag 7. So I do think earnings continue to matter, but where we're seeing that relative strength is going to shift a little bit to other parts of the market.
Okay. Kara Murphy, Bob Elliott, great to kick off the hour with you.
Thank you.
With all the major averages finishing the day higher, though still lower on the week. We'll take the green on the screen. Meantime, President Trump is speaking at the White House Digital Asset Summit right now after moving to establish a strategic Bitcoin reserve. CNBC's Mackenzie Sigalos joins us with the latest. Mackenzie.
Hey, Morgan. So the president just wrapped up comments at the White House Crypto Summit, laying out his plan for the strategic Bitcoin reserve and crypto stockpile that he just set into motion. Already, we're seeing crypto prices start to recover after what's been a rough 24 hours of trade in the wake of what should have been good news for the industry. The president saying that the federal government is already among one of the world's largest holders in the world with its $17 billion worth of Bitcoin on the books. He also talked about the Biden administration prematurely selling billions of dollars worth of crypto. Now, Trump says that the Treasury and Commerce secretaries will explore new pathways to accumulate new Bitcoin holdings at no cost to taxpayers. And he's looking at how to transfer those coins to the Treasury and deciding on a custody partner. Coinbase is among a larger group of crypto proxy stocks, ending the day higher. And really, that's the big question here. Will the administration roll out a budget-neutral buying strategy, which is the catalyst that the market really wants to see? Also in the room are SEC Commissioner Hester Peirce and the acting chair of the CFTC, along with his cabinet, what really is a show of force in favor of the industry.
And this is fascinating to me because budget neutral is a loaded word in Washington that has a lot of policy implications to it. And if you're going to start actually actively buying Bitcoin, it seems like you need to get lawmakers in Congress on board to be able to do so. I don't know how much, insight you have into that. But one of the things that I find super fascinating, and you and I were talking about this on Power Lunch, is if you're just talking about what the U.S. government already has potentially right now, if it's something like $17 billion, just to put it in context, the Strategic Petroleum Reserve is at about $23 billion in assets and where they're valued.
Well, to your earlier point, the Trump team has been working with Senator Cynthia Lummis, who last year brought forward a Bitcoin buying bill, an acquisition strategy of purchasing 1 million Bitcoin over the course of 5 years. There's, certainly momentum in that direction that she might bring a similar bill forward. But in terms of looking at just the holdings that are already in place, I was speaking with Coinbase CEO Brian Armstrong, and it's his sense that, we would see the G20, many of those members follow suit, because this is like a very tremendous stockpile just by virtue of the tokens that have already been seized and are on the U.S. on the books of the government.
All right. Mackenzie, thank you. Mackenzie Sigalos. Well, stocks closing out their worst week of the year so far, with the S&P 500 now off more than 6% from the record highs. Let's get to Mike Santoli for more on the damage. Mike?
Yeah, John. So the last 4 days, the market was trying to make a stand. The S&P 500 kept crisscrossing this 5,700 level, finally settling above it. It was 1% above the intraday lows today. So you can squint and say, okay, maybe the market is suggesting some of the selling pressure is easing off around these levels. It might also be significant, at least in sort of a scorekeeping sense, that the low from today was 56.66. It was like within a point of this high from mid-July that I keep pointing to. Who knows if that meant that we finally just sort of like tagged it, made a proper reset, went back half a year, and now it's time to sort of see what might be able to break right as a matter of relief. Take a look at the history of how 5% plus pullbacks in the S&P 500 have gone on to either present further gains or not. Historically, about 60% of those 5% plus pullbacks eventually do not get to a full 10% correction, and so therefore they're buying opportunities. This is from Warren Pies at 314 Research. So the overall pre-financial crisis average, it showed you that, generally a good buying opportunity after the 5% level. On average, you don't have too much more downside. This, however, is since 2022. There's only 6 instances, but it's been a little more likely that you're getting a full correction. The best time to be a dip buyer was right after the financial crisis with interest rates super low, no inflation to worry about. Therefore, any pullback in yields and stocks meant that the Fed could kind of be there, come to the rescue, and it could actually be supportive on a fundamental basis. So, you kind of use the probabilities here and say, usually this is not the worst time to start going in, but you have to be ready for a little bit more of a gut check along the way.
Mike, one of the many things that the charts don't show us is sentiment, feel. It seemed to me like in early November, right after Election Day, so many people in the market in corporate America thought they knew exactly how it was going to feel for business in a second Trump administration. The feel, I think it's fair to say, is very different now with the environment that we've been in. So given the seasonality, spring's about to start in just a couple of weeks, what does all of that set up for the market?
Well, I think now it's the time to ask whether that sentiment, business sentiment, investor sentiment, has actually swung all the way to essentially have a full reckoning after that burst of optimism we got after the election. Because almost all the measures are showing that. All the market-based measures that say, are we pricing in an acceleration or not? Are we pricing in more deals or not? Have also rolled over. So it's almost as if the market is telling you, we round-tripped on this thing. And historically, I know I keep pointing this out, whenever you have high perceived policy uncertainty, and everyone's passing around those charts where it's spiking to the moon right now, it is usually meant that it was more of a buy than a sell signal for stocks, because it meant all the uncertainty was kind of at least getting recognized and probably priced in the market. So I know that sounds Pollyannish, but that's somehow the way it can go from here.
You Pollyannish?
I was literally just having the same thought.
Mike Santoli, we'll see you again in just a little bit. After the break, is it safe to start looking at tech? Well, we'll talk about the brutal stretch of trading for the NASDAQ 100 and which names should be on your shopping list, perhaps, to buy on the dips.
And speaking of tech, Palantir rebounding by 5.5% today after falling more than 30% from its recent highs. We're going to tell you what's behind this bounce back next. Overtime is back in 2. Welcome back. The tech sector getting slammed this week. The Invesco QQQ ETF touching its lowest level since October of last year. Is this pullback a buying opportunity, or should you steer clear? Well, let's discuss that. Let's bring in EMJ Capital founder Eric Jackson and T. Rowe Price portfolio manager Tony Wong. It's great to have you both. Eric, I'm going to start with you. Is this a buying opportunity, or do we have further to fall?
Hey, Morgan. I think you want to kind of see how the beginning of next week plays out. I think it's quite likely we're near a bottom, and certainly sentiment seems washed out. But we've gotten a few head fakes just in this past week. So I would love to see the QQQs like hit 500, maybe like something like 498, 497, slightly higher than where we closed today, as sort of like a sign of an all clear. But then, once we get that, there's a lot of buying opportunities with this 10% correction under our belts here.
Tony, I want to get your thoughts on, we've been talking about a broader stock rotation, looking across the sectors of the S&P, but I wonder if we're seeing one within tech, within software, within the AI trade in general right now, and maybe that is shifting from the so-called picks and shovels, or at least the original players like the NVIDIAs of the world, to other players now, maybe case in point Broadcom after the earnings we got after the bell yesterday. Your thoughts, and if so, what's compelling?
Yeah, I think that, within tech, there's always groups of stocks that are working and groups of stocks that are not. And so I think that you saw the Mag 7 really dominate the last 2 years. And I think going into this year, I think that there's a lot of concern over the CapEx that's being spent. They're kind of becoming fundamentally different businesses in some respect in terms of the capital intensity. And then on top of that, you had kind of more inline reports. And so when you're spending a lot of CapEx and you're coming in line, I think that tends to set up for a tougher stock reaction. And so, I think there's other areas in tech that naturally things will broaden out to, like things that have more bottoming fundamentals and can have a little bit easier setup. So I think that, we're looking for like more broadening. And, I think that these are still like very good companies and they're still like a core part of tech portfolios. But I think there's opportunity elsewhere as well.
Eric, at what point is it not really an issue of market timing so much as you look at a group of stocks, and if you're looking to be in them for 3-5 years, it's just a decent time to buy? And I look at MongoDB, which really had a rough print based on the guidance. It's trading now about where it was part of the spring of 2020, May 2020, 5 years ago almost. I look at Samsara reaction to that stock, which tends to guide conservatively anyway. We've got the CEO coming up soon. C3AI, similar, down near $20 a share. These are the names that were high flying. They're certainly at low altitude now.
Yeah, I think you're right, John. I would just say that rather than go for some of those names that you just mentioned, like Mongo, I like some smaller names that have had some recently like really strong earnings, but they're still kind of under the radar. So, one of my favorites is Root Insurance right now. Swung from like a loss of 170 million, a year ago to like now being squarely in the black, making 30 million this past year. 2 really strong earnings reports back to back. They're one of these insure tech IPOs that came out in 2021. But they're like, they're at 130 today. They came out at 500. They probably deserve to be back at 500 at least by next year, and yet they're still sort of flying under the radar. Chinese internet names are probably the part of tech that are working the best. Everyone talks about Alibaba, but I own a VIP Shop where 56% of its market cap is cash on the balance sheet. I just think there are some other names like that. Rigetti Computing has been sort of forgotten about after Jensen's comments in January, and yet the week after next, NVIDIA is having its Quantum Day. So I guess Quantum's maybe not 30 years away, and so I like some their earnings and their partnership that they announced a couple of days ago.
Tony, at what point can you buy a basket? I know stock picking is fun and everything, but for investors who aren't looking to take on that fuller risk, I'm looking at the IGV at 93. It's just a bit above that peak from late 2021, and there are some other things that are way off that are whole baskets of stocks. Are the smaller software stocks just in general closer to a buy?
Yeah, it's really hard to probably talk generally, but I think that a lot of the software stocks that are down, like you mentioned, there's there's good reason for them. And a lot of times the valuation has been really expensive, and just because they're down from kind of a super peak doesn't mean that they're necessarily buys. In my opinion. So I think you want to wait until there's stronger fundamentals. And a lot of times these software stocks, there was such a big pull forward kind of over the last few years that for them to reaccelerate and start beating earnings can be difficult.
All right. Tony and Eric, thank you both. Elsewhere in the tech universe, Palantir marking a key milestone today, delivering the first 2 AI-enabled Titan vehicles to the U.S. Army. Now, Palantir doing this after being awarded $178 million for the program a year ago. They delivered on cost, on time. This phase of the program includes 10 vehicles across 5 delivery orders. So what is Titan? Well, you can see it right there on your screen. This is the Tactical Intelligence Targeting Access Node. It's an AI-defined and mobile intelligence ground station that integrates data. Titan is essentially an AI-enabled supercomputer on wheels that doesn't need to plug into the cloud. Palantir president for U.S. government business, Akash Jain, calling this a, quote, leapfrog moment, telling me the software-centric nature of the Army's investments signals an important shift for the military and for the defense industry writ large. Now, Palantir partnered with Anduril Industries, Northrop Grumman, L3Harris, among others, on this program. You can see the stock is popping today. It finished up 5.5%. It outperformed the broader market and most of the broader growth and momentum names. But John, case in point here, when you talk about how the military is going to be fielding new technologies and new software and doing it with an eye to costs and the defense budget more broadly, this might be an example, one of more coming of programs where new companies are doing things differently.
I know you'll keep an eye on it. And now we've got a news alert on Robinhood. Kate Rooney has details. Kate?
Hey there, John. So Robinhood is settling with one of its financial regulators, FINRA, over some regulatory matters that date back to 2014. This does appear to clear the decks pretty much for outstanding issues on the regulatory side for Robinhood. It did settle with the SEC recently, and then that agency also dropped its investigation into Robinhood's crypto business. This one is a $26 million settlement with FINRA plus $3.75 million in restitution to customers. A couple issues here with the FINRA disclosures. A big one was disclosure. There was an issue about anti-money laundering programs, monitoring suspicious activity, and then another had to do with collared orders that tend to protect investors from volatility. It's how they disclose that to customers that was the issue. Robinhood does not offer collared equity market orders at this point. In a statement, though, Robinhood saying they're pleased to resolve these historical matters. They say it does date back to 2014, and Robinhood Securities and Robinhood have since remediated those issues. The stock has had a rough week as growth names have gotten hit. It's been down about 9% in the past 5 trading days or so, guys. Back over to you.
All right, Kate, thanks. Well, still ahead, we're going to talk more about the tech trade, or really specifically demand, when we're joined by the CEO of Samsara, ticker symbol IoT, closing lower by 15% today on the back of earnings results.
And we'll look at the one thing happening in Washington next week that could inject, only one thing, that could inject another dose of volatility into this market.
One thing we know.
Over time. We'll be right back. Yeah, that's good framing. Welcome back. Stocks wrapping up an ugly week of trading, and this morning's jobs print adding to concerns about the health of the economy. So let's bring back Mike Santoli for his take on that report. Mike.
Yeah, a little bit nuanced, Morgan. I think on the headline, it was reassuring enough. You know, the job growth in total in the month was more or less in the zone of expectations. And this shows the what's called aggregate weekly payroll income measure, which adds in the net change in new jobs, the average work week, and then average hourly wages to get some kind of a proxy for private sector payroll income growth on an annual basis. See, it's kind of hanging in there on the year-over-year metric pretty well, and actually very close to the kind of pre-pandemic typical 5% give or take average. But the 3-month annualized version, so the more recent data, shows a little bit of a dip here, and it's sort of the lower end of the post-pandemic range. So it's one of the reasons why it feels as if the job market is steady, but definitely not strengthening, and perhaps kind of approaching some kind of a stall speed if we have an issue with labor supply or a little bit of a bulge in layoffs, Morgan.
All right. Mike Santoli, thank you.
Yep.
Now it's time for a CNBC News update with Bertha Coombs. Bertha.
Hey, John. President Trump is expected to sign an executive order that would exclude some student loan borrowers from the Public Service Loan Forgiveness Program. The president today accused the program of including organizations that engaged in illegal behavior. The program allows nonprofit and government workers to have their federal student loans forgiven after 10 years of repayment. Poland will require all adult men to undergo military training as the country readies itself for threats from Russia. And the prime minister said the country is looking to gain access to nuclear weapons. The prime minister told Parliament today he wanted to increase the size of the country's army to 500,000. Officials in Santa Fe, New Mexico, are currently giving an update in the investigation into the deaths of Gene Hackman and his wife, Betsy Arakawa, who were found last week in their home. Their medical examiner says Hackman's wife likely died first from a severe respiratory illness caused by the hantavirus, a rare disease spread by infected rodent droppings, and that 95-year-old Hackman died of heart disease and showed severe signs of advanced Alzheimer's. Very, very sad case, John. Back over to you.
Yeah, it really is. Bertha Coombs, thank you. Still ahead. Much more on the White House's plans for crypto following the Digital Asset Summit and the establishment of a strategic Bitcoin reserve.
But first, the CEO of Internet of Things company Samsara joins us as his stock falls post earnings and guidance. We'll talk about what he's seeing in software and logistics demand when Overtime comes right back.